A slow, tightening pressure is currently the primary threat to your wealth. This macroeconomic force works incrementally, applying a sustained grip on the financial system that is often more damaging than a sudden market crash. Behind closed doors at their July meeting, the Federal Reserve revealed a startling internal shift. While the public expected interest rate cuts, several policymakers argued that rates might actually need to go higher. 3 officials went as far as formally dissenting, pushing for an immediate increase. This creates a period of intense economic friction. The Fed's current policy rate sets in the 3.5 to 3.75% range, while the latest data shows the unemployment rate at roughly 4.1%. These numbers trigger the dual mandate, the Fed's legal requirement to balance 2 competing goals. They are trying to crush inflation with high rates without suffocating the job market and triggering a recession. This internal struggle has led to a state of policy paralysis. For the American investor, it means interest rates are likely to stay higher for much longer than the market anticipated. This chart shows why the Fed is hesitant. While standard consumer price data trends downward, the preferred PCE index remains stubbornly elevated above the 2% target. The labor market sends mixed signals. July lost 23,000 jobs, yet weekly unemployment claims simultaneously declined. The labor market is cooling off unevenly. If the Fed cuts rates to support workers too soon, they risk reigniting inflation, but waiting too long to act could break the job market entirely. This data paradox causes immediate volatility in the bond market. Specifically, we see it in climbing Treasury yields, which reflect the market's growing anxiety over the Fed's next move. Because the Fed has hit the brakes, a downward cascade of capital has begun, and the first point of impact is Wall Street. We saw this play out on August 20th. As Treasury yields climbed, investors sold off high-valuation technology and growth stocks. The S&P 500 fell 0.4%, while the Dow dropped 430 points in a single session. The logic is simple. When the government pays a higher yield on safe Treasury bonds, investors demand a much higher return to justify the risk of holding corporate stocks. Capital naturally drains out of the market and flows towards safer institutional assets. This shift extends far beyond the stock market. It reaches the very foundation of the financial system, the $40 trillion of U.S. government debt. Sustained high yields drastically increase the daily cost of financing this national debt. The government must now commit more of its budget simply to cover rising interest payments. Investors are now demanding higher compensation to account for government borrowing and geopolitical uncertainty. As a result, the bond market has become the primary driver of the economy's future, overshadowing the stock market. For everyday Americans, these high rates translate into direct costs. Mortgages, auto loans, and credit card debt have become painfully expensive, putting a significant strain on anyone who needs to borrow money. However, those with significant cash reserves are seeing a different reality. Savers are currently earning some of the highest yields on cash and fixed income investments in decades. This higher-for-longer environment has created a sharp financial divide. Your experience in this economy depends almost entirely on whether you are currently carrying heavy debt or safely holding on to cash. To understand which way the economy will move next, watch 5 specific indicators: inflation data, employment numbers, Treasury yields, oil prices, and Federal Reserve signals. If inflation falls while the labor market weakens, markets will likely price in rate cuts. Conversely, if inflation accelerates again due to rising oil prices or sticky data, the threat of a September rate hike becomes reality. Avoid making investment decisions based on a single headline. Even with stocks near historic highs, the underlying risks to the financial system remain both present and highly significant. The American financial system is currently caught between inflation, debt, and economic growth. Whichever force moves first will dictate the future of your money. For simple, USA-focused financial education, make sure to subscribe.